Hey investor friends, I'm Michelle Markey, and today's video is part of a recurring theme I call Mind the Investing and Wage Gap. And if you recall from my LVest video, the rise of women investors. And in today's video, I'll be reviewing the 2011 Warren Buffett Invest Like a Girl by LouAnn Lofton. And in this book, LouAnn covers how Warren Buffett's investing temperament is much like how women tend to invest, and they look towards investing for the long term, tend to be risk aware, and they don't follow the crowd or be subjected to too much peer pressure. And there are many other attributes where LouAnn compares Warren Buffett's investing style to how women invest, and it's kind of cool to evaluate how much we think about how our tendencies from our genders might influence us to invest in certain ways. But for the most part, I'd actually kind of give that a little bit of a grain of salt and think about how we can more so emulate the way Warren Buffett and Charlie Munger invest. And I like how the author talks about how they do this like a girl, because being or doing anything like a girl used to be more of an insult, and now it's pretty badass to do anything like a girl. So I'm pretty pleased that it puts a positive spin on that idiom used as like a girl. And before we get into more about what the book says and what I thought about it, I'd also like to reflect on how on this upcoming Monday, January 18, 2021, is Dr. Martin Luther King Day. And I'd like to cover some of the quotes that I think can relate to our financial and investing journeys. And also, Warren Buffett felt that civil rights changed his views as he was influenced by his late first wife, Susie, to care about some current events. And so to reflect some of what Dr. Martin Luther King stood for, I'd like to read a couple of quotes to you. Change does not roll in on the wheels of inevitability, but comes through continuous struggle. All labor that uplifts humanity has dignity and importance and should be undertaken with painstaking excellence. And rarely do we find men who willingly engage in hard, solid thinking. There is almost universal quest for easy answers and half-baked solutions. Nothing pains some people more than having to think. And we are prone to judge success by the index of our salaries or the size of our automobiles rather than by the quality of our service and relationship to mankind. And I believe that unarmed truth and unconditional love will have the final word in reality. And I'm really grateful for the lessons that we got from Dr. King, and they give us a lot of wisdom and things to think about when it also comes to our investing journey. With these feel-good messages from Dr. King and Warren Buffett, I'd like to wish everybody some peace, and if you could please like and subscribe on my YouTube channel, I'd be super grateful. Thanks. LouAnn emphasizes how Warren Buffett's investing temperament is much like how women tend to invest. And to define what temperament means, it's a person's nature as to how it permanently affects their behavior. It's reflective of how you control yourself and your urges, and you're neither with the crowd nor against the crowd. And this book was written not too long after the Great Recession, in which people's temperament caused a lot of what happened during that Great Recession, where there were excess levels of debt, there's a lot of short-term thinking, there was a lot of hoping that the next fool will buy ever-rising house and stock prices. So with that, it just shows how Warren Buffett's temperament is much more calm, cool, collected, and he doesn't react to short-term activities in the markets. He tries to take a long view of how he would like to invest in companies for forever if possible. And that's not how Wall Street tends to perform when they go by a quarter basis of performance. That's very short term. I'm gonna kind of challenge this next topic, which includes a murky area of what risk means. And this book more or less defines investing risk as volatility in the market, which is the variation in trading price over a period of time of, say, a given stock. And the other form of risk that the author LouAnn cites is from a 2001 study by Barber and Odeen, where they equate risk to, in addition to volatility, also known as beta in their writing, is also small firm companies. So basically, based on this study and LouAnn's book, they equate investing risk to volatility and buying a small company. And I actually consider risk to mean the ability to permanently lose capital. So with our varying definitions of risk, this is a point where it's going to be a little bit contentious, because if you judge the stock market and if you want to buy a company based on how much a company might go up and down, that might lead you down a certain path that I don't find super agreeable, and I don't think Warren Buffett invests that way, with worrying about volatility, because it shouldn't have to matter how much a stock price goes up and down if you're not looking to sell it anytime soon. If you're like Warren Buffett, where you hold a stock forever, it's immaterial how much a stock fluctuates, or how Charlie Munger puts it, the vicissitudes of life. And throughout so many years, you probably could care a lot less whether the Dow Jones index goes up or down by 1,000 points or whatever percentage that is at the time. And it really doesn't matter, or shouldn't matter, if you are investing the way that Buffett and Munger do. So the other point I want to make when it comes to risk is the study from Barber and Odeen found that women tend to have less risky portfolios in their common stocks. And I find that questionable, because I don't necessarily think women may choose safer securities compared to men. I think that we could all choose equally risky securities depending on what our motives are, if we buy it at too expensive of a price, if we didn't really study the company and its management and other factors that are involved when it comes to investing. And then the book talks about how you would think that higher return should come from taking higher risk, which men might tend to do according to their definition. And I also don't necessarily agree that you would equate having higher volatility with the potential for higher rewards. And then the book also goes on to argue that any advantage that could have given men tends to get traded away, and men tend to maybe trade a little bit too often, resulting from factors like having an overconfidence. And it's not to say that women are any less confident, or they shouldn't be thought of as being less confident than men, but because women tend to be a little bit more realistic when it comes to evaluating stocks, maybe sometimes that might be why the advantage that men could have had by supposedly investing in riskier stocks might not be that advantageous. And LouAnn's book actually finds that women's investing results barely edges a little bit better than how men perform, except when it comes to hedge funds, where women hedge fund managers actually significantly outperform men by several percentage points. And then in downturns, they are half as bad of a down percentage compared to men. So with some of these factors, it's kind of cool to think about and also challenge for yourself if you agree or disagree with some of these points. Regardless of whether some of these are feminine or Buffett traits, we can all benefit by doing more of these things that include learning from our mistakes and deeply researching every aspect of a company before we invest in it, and also considering alternate or inverted points of view. And one example I'd like to share on that point is how famous investor Bill Ackman made an inverted case about Chipotle. So he went on CNBC to tell a bunch of people how maybe someone shouldn't be investing in Chipotle, and listed all the points why it would not be a good investment. So these are also important things to consider, that we don't just try to look for evidence that supports our hypothesis, but we also look for the evidence against, or why we think we could be wrong if we were to invest in a company. And that's a very valuable point of view to consider. And the last point is to trade less frequently. And that's something we could all benefit from, doing less trading. And I know with the advent of brokerage firms reducing or eliminating completely their commissions and fees, like Robinhood greatly spurred this trend. We used to have a lot more commissions, transactional costs. And that meant that you had to be careful about how many stocks you felt like trading. It becomes a lot more like a game now where you could just easily buy and sell stocks without the repercussion of paying the commission transactional fee. And although it's lucky in a way that we can easily do that, at the same time, if we do so much trading that we're constantly glued to the ups and downs of the market, we could end up making worse decisions than if we were holding strong in our convictions about a company that we've researched thoroughly and that we're confident we can hold it for 10 years or more. Even if we don't always hold it for that long, if you go in with the mindset that you're going to own this company for a very long time, you're more likely to stay true to that and not necessarily give in to the whims of the market and then immediately sell back your company that you bought. And even though Berkshire Hathaway has 49 stocks as of when I recently checked in January 2021, it seems that the top 7 holdings of Berkshire Hathaway at 2% or more of the portfolio allocation is very concentrated. And Berkshire even has 48% or nearly 50% of their portfolio in Apple alone. And Charlie Munger is similarly weighted heavily in banking stocks in his portfolio. So it just goes to show that you don't have to be trading so much and you don't have to own too many companies in order to have a respectable portfolio that can provide good returns over time. So less trading and more just kind of sticking with good companies for the long term. On the controversial topic of diversification, I talked about this in one of my videos about debunking myths of investing, but Warren Buffett believes in investing in very few companies because he wrote in a 1993 Berkshire Hathaway letter to shareholders that he and Charlie decided long ago that they want to make the smart investing strategy because there's no way they can understand and know hundreds of companies. So their philosophy is to invest in very few companies, which tends to be less risky in their mind because you have a high intensity of thought about the company and you have a comfort level about the economic characteristics of the business. So with that train of thought, and also how Buffett agrees with me in that he defines risk as a loss or injury, and with this train of thought, this is a way that we can stay safe and only have companies that we really believe will be good investments in the future. Whereas the author of this book represents a motley fool, and their philosophy tends to agree with Warren Buffett's mentor, Benjamin Graham, where they think that investing in many companies is a good thing. So they advocate for investing in 15 to 20 companies and also some index funds to maintain diversification. So I find that interesting that LouAnn included a contradictory message from Buffett that goes against what the motley fool believes, but it's good that they're including an opposing view. Some more points that I found to be insightful were how the book talks about Buffett saying that approval is not the goal of investing and you shouldn't be seeking applause for investments, and usually the great moves are greeted by yawns. And a female investor that this book interviewed also talks about how she thought there was a great case for a certain car company back in the times of the Great Recession, and everybody around her was complimenting her and saying what a great investment that was, and it turned out to be one of her bigger regrets. So it just goes to show we should be careful about seeking the approval from other people's opinions about whether an investment is a good idea or not, or seeking that affirmation of our decisions. We shouldn't let ourselves be influenced what other people tend to think. We need to have it in ourselves to support why we think a company would be good, regardless of whether we get applause from anyone else. And the book also talks about how Buffett earlier in his career resisted bending to mob rule, and he stayed strong by not investing in what was known as Nifty 50 stocks back then, and he did his own thing by investing in companies that were on sale. And he also said that you should have a systematic approach and framework when it comes to investing and stick to it. A few more pearls of Buffett wisdom that I like is how Buffett said that a climate of fear is an investor's best friend, and euphoria is the enemy, and uncertainty is the friend of the long-term buyer. And around the dot-com bust, Buffett thought that it's not like he's a Luddite. He isn't against technology per se. I mean, now he's heavily invested in Apple, like I said. But back then, he didn't know how to predict the future of what was going to happen in the technology industry. So that made him inherently uncomfortable. It's not that he didn't have the capacity to understand technology and prominent technological companies, but because he had difficulty predicting where things could be in 10, 20 years, he didn't invest back then. But I think we're pretty certain that Apple is pretty situated now. The book is a pretty brisk read, and sometimes it gets to be a little bit repetitive, but there's a lot of great insights placed throughout the book and in the appendices with the full interviews with primarily female investors and one guy investor from Motley. And I like what they had to say about how having a fire in the belly and the curiosity to learn and have a broad range of interests is important. It's more important than having an IQ. And they also pay attention to how management of companies do capital allocation. So I like points towards that, as well as being able to control your emotions is a sign of a good investor. And last, that the day you invest is actually the day when the work begins, because now you need to actually keep tabs on the company and how they're performing and keep assessing whether this was a good investment or if you might need to change course if a company isn't living up to what you expected. So there's a lot more insights than what I'm mentioning here, but those are some of the highlights that I wanted to share. The last couple of points I want to touch on is how investing is like shopping for good value, which I'm surprised the book doesn't talk more about this female tendency, because we're always shopping for good deals and we never want to feel like we're overpaying. And the other point is that we need to have courage of our convictions. And this means that on face value, if our stock is going down for a while, on the surface, we could look like we're wrong for weeks, months, and years, but it requires that we have discipline and stay grounded to stick with companies and what we believe our investment thesis is. If we think we're right in the long term, it won't really matter what happens in the short term with the market's fluctuations. So if you enjoyed this video or learned something, please like and subscribe, and I wish you well on your journey towards financial freedom. Till next time.